from ADK Wealth Advisory Group in St. Louis. As many of you know, my name is Dan Davis. Our purpose today really is twofold. One is to look back at third quarter 2014, and then second is to look forward to the fourth quarter as well as the first quarter of 2015. As we look back at the third quarter, if you go back into discoverindependence.com and view the Q3 video, you'll see we really talked about two things. One was bubbles, and two was our outlook. And as I summarized before, we don't really think that we're in a bubble right now, not that one couldn't be created. We also think that when you take a look at the short-term outlook between now and say the end of 2015, that we're very optimistic. I would say normal circumstances relative to financial markets. In the Motley Fool advisory report that comes out monthly, they recently said that if you look on average, every 11 months you see a 10% stock pullback. So normal volatility, but being rewarded with reasonable returns. Our real concern is when you look at that intermediate term, when you go 2016 to 2020. And then when you go long-term 2020 and beyond, we're very optimistic. So looking back specifically at third quarter of 2014, a couple things I think are really kind of interesting. One is probably best if we use some definitions. If you take a look at the secular cycle, if you see the Bloomberg chart that we're showing, you can see that it goes all the way back from 2000 through current time. You'll see that the extended period, it's a Latin root word called secular that means long term. And in looking at that, this long term we're in a secular bear market. Now if you look at 2000 say through 2003, the beginning, you see this extended pullback that goes on. So there you're seeing a cyclical part, which is a short to intermediate term cycle. And looking at that, you can see that that's a short term bear. Now from about the spring of 2003 to the fall of 2007, you see a cyclical bull run. So you can have a cyclical bull inside of a secular bear. Many of you have heard us talk about that before. We believe that we're in a cyclical bull run right now that really started in 2011 and has continued. If you take a look at the Bloomberg chart that looks at this 2011 period, you can see that we had approximately about a 17% pullback, and then it started to run back up since. In the third quarter, we had a couple cyclical pullbacks inside of this run. One, if you go back and you take a look at late July to early August, was a little less than 3.5%. Most recently, which I think really concerned a lot of people, was the pullback that happened sort of late September through mid-October. And it went down as much as 7.4% on the S&P 500. We think that those kind of pullbacks are going to continue for a while. And the reason that we believe that is if you take a look at cyclical bull runs, they kind of go in three cycles. Phase one of that cycle is sort of, it's more ramped up at a high increase both in earnings and in stock returns. Then you start to get diminishing returns where they're still going up, but they're going up at a slower rate. And that's the period that we're in right now, the second part. We think that we're at the last part of that though. The third part is though where it starts to flatten out. And that's where it really gets choppy. Earnings and stuff is still going up but at a much slower rate. And then you'll see that the markets get really choppy, headed up, but with increased volatility. We believe that in the fourth quarter or first quarter of next year that will begin the beginning of that phase. Now why do we believe that? If you take a look at some things like say for example the stock market, and I'm really talking primarily the S&P 500. As of Halloween, 70% of the companies have reported earnings, and if you were to summarize it, you would say favorable. But again, getting back to that point that we were saying is that earnings are no longer going up at faster clips each time. They're now going up, but they're going up at a decreasing increase. For example, When you take a look at those 70% of the companies, the majority of them met or exceeded earnings, but their earnings went up at a slower increase than last quarter. The real significant thing is on guidance. If you take a look at what 2015 guidance was going into this earnings season versus what it is now, guidance is about 2% lower. Thus the statement earlier that I think we're heading into the beginning of the third part of this cycle. A couple other things, central banks. Pretty fascinating stuff happened here today. Halloween represents many things in a ghoulish way, but some things in a good way. The United States has discontinued its Federal Reserve asset repurchase. The Bank of Japan promptly announced that it was going to increase its asset repurchase, which is pretty interesting because when you take a look at what asset repurchase does, it really is a central bank printing money and using that printed money to turn around and buy some type of debt instruments, in this case the debt of its own government. Very stimulus in orientation, and I'm glad the United States has finished his. If you take a look at the ECB, Europe really needs, from a standpoint of stimulus, they really need intelligent stimulus. However, the asset repurchase has been a little bit elusive. Draghi has really tried, but when you take a look at Germany's stance, they really realize that they don't want to fund the fiscal irresponsibility of Southern Europe, and they're doing okay, so their incentive to want to do things to help the part of Europe that can really come back and hurt them is very low. One of the things that's been very favorable about the ECB is they've finished a year-long stress test of their banks. And there was no real earth-shattering news that came from that. But what was really good is that over the last year, the ECB now has a much firmer understanding of really the kind of assets / loans that their banks in Europe have. And they know which banks are the stronger banks and which ones are the weaker banks. And in many cases, these weaker banks are going to be forced to merge in with the stronger ones because they won't be able to raise the kind of capital that's necessary. In all, I think that's favorable for Europe. When you move away from central banks and you take a look at other favorable asset classes, you take a look at commercial and residential real estate in the United States, very favorable, especially on the commercial real estate side. When you look into interest rates, some really fascinating things have gone on with interest rates, particularly the summer of 2013 when Bernanke announced the beginning of tapering. You saw interest rates spike up quite a bit. And it's very common that when that happens that you'll see this long period where interest rates go up, but they don't go up just in this straight line. Rather, what will happen is they'll go up, but too much, they'll come back, but the new low is higher than the previous low. And so you get this jagged edge that goes on. Well, this year we've seen that pullback, and a big part of why interest rates have gone down in the United States is kind of clearly seen as to what's going on in Europe. Months ago, the German bank went out and issued 2-year Bundesbonds at negative yield. To make sure we're clear on that, what that means is if you buy this Bundesbond and you own it for 2 years, you're guaranteed you're going to lose money. Not a lot, but you're going to lose money. So needless to say, much of the global capital that normally would go in and buy that kind of debt has been not so interested in it and has moved to the United States, pushing down our yields. As sort of a footnote, the amount of capital that went into that 2-year issue was still oversubscribed, which means there were more buyers than what they needed to sell the whole issue, which is pretty fascinating with interest rates. Our expectation is that interest rates will continue to kind of do this over time, but in that upward slope. I would expect that for the fourth quarter of 2014 and for the first quarter of 2015. And probably the asset class that got hurt the most, again, will fall into the grouping of commodities. If you look at commodities like gold and oil, to say that they've been hammered would be an understatement. But when you take a look at different types of ores that are ultimately used for steel and a lot of things with building, and they have been absolutely crushed, which hurts places like Brazil. A side note that I thought was interesting is we met with John Corkin, a senior client portfolio manager over at Oppenheimer Funds last week. And one of the things I thought was a very interesting takeaway is when he takes a look at what's going on with commodities, he would say that is a great example of the commodity markets showing that they believe that you're seeing a global slowdown. If you take a look at the IMF, the International Monetary Fund, they made notice in the New York Times that they've lowered their projection for the global economy in 2015 from 4% to 3.8%. Again, that's really consistent with something that's in the third part of a cycle. Our expectations for the fourth quarter as well as for the first quarter 2015 would kind of be more the same of what we're seeing right now. Risk being rewarded, but with lots of volatility. In summary, I would reiterate that in the short term, we expect reasonable returns with normal volatility. I don't think that normal volatility will feel very good. It never does. In the intermediate term is where we really have major concerns, and we're really talking 2016 to 2020. I think in an article that I read in The Economist sums it up the best, and that is that when you take a look at debt in the developed world, it's really at excessive levels. And that is where I think is the root of that intermediate term problem. In the Eurozone, the debt to GDP of the Eurozone governments has gone from below 70% to above 90%. And that's really significant because they say if a government's debt to GDP is below 70%, that they're in a safe zone. If it's above 70, that they start to rev up RPMs. When you're above 100%, it's like in your car where the RPMs are really at that level where it's whining. So we're not at the whining level, but we're certainly approaching that. In the long term, we're very optimistic when you look at the trends that are out there. Once again, would like to say thank you for your time. Thank you for your business. And if there's folks that you know that you think could benefit from learning more about this, ask them to like us, ADK Wealth Advisory Group on Facebook. If LinkedIn is more your thing, then simply go to Dan Davis. Since there's quite a few of them, look for the one that is president and co-founder of ADK Wealth Advisory Group. And if social media is not really your thing, then simply go to discoverindependence.com and hit on the video link, and you'll be able to see this and more. Thank you and have a great day.